Just imagine real estate agent commissions, attorney fees, inspections, and financial transactions on your federal taxes. You must pay all this to sell your home. If only you could avoid paying so much, or at least a piece of it. But wait, before calling the police, nothing is illegal here, and we won't avoid paying taxes. But I will share exclusive knowledge so you can understand the tax laws and utilize specific strategies to minimize your tax liability and maximize your tax profits. Understand capital gain tax first. Let's begin with capital gains. Capital gains arise from selling capital assets like stocks, bonds, and real estate, resulting in taxable profits. These taxes are incurring only upon the sale of an investment. Good news, Florida does not impose a state capital tax gain. Bad news, federal taxes must still be paid on property sale within the state. The exact tax rate is contingent upon various factors, including the duration of property ownership and the seller's income level. Guess what? Federal gains taxes can be avoided, but only if you adhere to IRS regulations and meet specific primary residence or income property criteria. Capital gains are characterized as short-term or long-term. Short-term capital gains apply to properties held for 1 year or less and are taxed at ordinary income tax rate, which can reach up to 37% at the federal level. Long-term capital gains apply to properties held for over 1 year and are subject to a lower tax rate, typically from 0% to 20%, contingent upon the seller's income. Take advantage of the primary residence exclusion, one of the most beneficial tax tricks for homeowners selling their residences in Miami is the primary residence exclusion. According to the IRS, homeowners can exclude up to $250,000 of capital gains from the sale of the primary residence, $500,000 for married couples filing jointly. To qualify for exclusion, homeowners must have owned and lived in the property as the primary resident for at least 2 of the 5 years leading up to the sale. Recovering the tax withheld, the 15% withholding rate of the sale price is generally higher than the effective U.S. tax rate on capital gains, which ranges from 0 to 20%. This means you may be eligible for a refund of any amount paid over the actual tax liability. To recover the overpaid funds, you must file a U.S. tax return that reports the capital gain from the sale of the property. The funds withheld under FIRPTA will be credited against your tax liability, and any excess will be refunded. In all cases, you must file a U.S. taxes return, even if you have been benefited from a withholding tax exemption under FIRPTA. 1031 exchange. Oh, and have you ever heard about 1031 exchange? It's named after Section 1031 of the Internal Revenue Code and offers a powerful tax deferral strategy. This tactic allows investors to defer capital gains taxes when selling one investment property and reinvesting the proceeds into another like-kind property. By deferring taxes on the capital gains from the sale, you have more capital available to reinvest, meaning you can buy new properties. The disadvantage of the 1031 exchange lies in its ability to defer tax indefinitely, meaning investors continue reinvesting in like-kind properties through exchanges. This approach primarily benefits investors seeking to grow their real estate portfolio and increase wealth over time without facing significant tax liabilities. Plus, the 1031 exchange offers flexibility in investment strategies, enabling you to diversify holdings of your portfolios based on changing market conditions or investment objectives. To qualify for tax deferral, identify replacement properties within 45 days of selling the property and complete the exchange within 180 days. Timing the sale. Consider the timing of your sale carefully. If your income is unusually high in 1 year due to other income sources like bonuses or inheritance, consider delaying the sale of your property to a future year when your income and potentially your tax rate is lower. This can reduce the tax rate applied to your capital gains. Charitable contributions, donating a portion of the property to a charity, can fulfill charitable goals and provide significant tax reduction. Converting rental properties, if you own a rental property and are considering selling, you might be first converted into your primary residence, so you can live in it for 2 years. After fulfilling the residency requirements, you could potentially apply for primary residence exclusion, thus reducing your taxable gains. Installment sale. Consider an installment sale, which the buyer pays you in an increment over a period of years. This can help spread out your capital gains tax liability over several years, potentially keeping you in a lower tax bracket compared to receiving the entire sale price in one sum. Energy efficient upgrade. Take advantage of liable tax credits to make your home more energy efficient. This can include solar panels, energy efficient windows, and different systems. While these credits may not directly offset capital gains, this can reduce your overall tax liability. Opportunity zone. If you're looking at reinvestment opportunities, consider opportunity zones. You can defer and potentially reduce your capital gains taxes by reinvesting capital gains into opportunity zone funds. Any new gains from the opportunity zone investment can be tax-free if held for 10 years. Keep detailed records of improvements. Another tax trick to consider when selling real estate in Miami is keeping detailed records of any improvements made to the property. While you cannot directly deduct the cost of home improvements from your capital gains, you can add this cost to the property's basis, reducing their capital gains tax liability. This tax-saving strategy is particularly beneficial for Miami, where state capital gains taxes do not apply. Document improvements that increase the property's value, such as a kitchen remodel or additional of a swimming pool, to ensure maximum tax saving. Retain receipts and documentation of all improvements made to the property. Then you can accurately calculate their capital gains and reduce tax liability by keeping receipts and documentation of these improvements. Consult with a tax professional. But don't take my word for credit. Before considering selling your home, I advise you to consult a qualified tax professional or accountant familiar with Miami's real estate market and tax laws. Luckily, I always have valuable contacts and I'm happy to share. So feel free to contact me. You can find all my information below this video. Also follow me on my Instagram account, which is realtor.katya. And don't hesitate to ask me in the comment section below. See you in the next video.